On the breakout, gold's going to make a new all-time high.
Gold-backed ETFs in inflows of over $5 billion.
$0.8 trillion gold market.
Why are we the only guys that seem to understand this?
Makes your head spin. Hey there, welcome to this week's edition of Live from the Vault. This is Shane Miranda. I'll be your host today. And wow, I hope everyone, first of all, is staying safe. You get to spend some time with your family and really start planning and focusing on your future. Times are changing, and thank God for Kinesis. I mean, I've been receiving a lot of calls, a lot of inquiries in the last couple of weeks, wanting to know more, and we've set up an entire system to help you learn step by step, no matter what your background is. Because some of you watching this video are already invested in silver and gold and accumulating, learning about the Kinesis system. As you go, as it develops, as it continues to move forward. And some have not. And my recommendation, my high recommendation is to at least start the process of learning about physical gold and physical silver and how Kinesis is the only, listen carefully here, is the only opportunity in the world that has defeated Gresham's Law. Okay, if you don't know what Gresham's Law is, you can, go to the website. There's a 10-minute movie we put together. But we've got an exciting, awesome update for you today. And that involves the CMO, Mr. Jai Bifulco, who is the marketing samurai in Kinesis. And he's going to bring a full update. We're going to go to him in a few seconds here. And then we're going to hear from Andy Maguire. You're not going to want to miss this. This is an update from a world-leading expert on what's happening in the physical and gold markets, since it's so important to everyone here. So we've got an awesome show. I'm fired up and excited about the future of Kinesis and how it's developing and how the timing is everything with Kinesis. Timing is everything. So with that, it's my pleasure to hand this call over to Mr. Jai Bifulco to bring us an update live from the vault. Here you go. Over to you, Jai.
Okay, thank you, Shane. Thank you for the introduction. So, hello, Kinesis community. Coming to you all live from the offices, the home offices of Kinesis and its crew. I hope everybody is doing well with the current situation with the COVID-19. And we do wish you all very well and hope that you and your families are safe. And as we, come through these trying times of isolation and quarantines, I just really wanted to, put across our assurances that everything at Kinesis is running smoothly and is running on track. Being a technology company, we have effectively been able to, all have our offices moved to our homes. And as we are connected globally via technology, it really hasn't impacted too much on our development at all. So we have had slight impacts, there is some time for everybody to get up to speed, but it has been minimal. And we've been lucky in that sense, and many other businesses haven't been. So we do, wish everyone the best out there. And as we continue forward into 2020, we are still out there, driving towards the goals and objectives of our products, and leading towards, our goals as well when it comes to our marketing strategy and our commercial strategies. So my aim today is just to give you a little bit of an update on what's going on, where we're at, and just to give you an insight into, what we're currently working on. And over the next few weeks, we're going to have some great updates to give you in some certain areas. So I'll kick on and get straight into it. And first of all, I really want to start with the app, the application. I hope all of you at this stage have downloaded the Kinesis app, which is available on the iOS and Android stores. The app was received very well. And for me, the app is a great tool. It allows us now, the mobile connectivity and it's a great way to just, have Kinesis on the go. But it really was a first iteration and a first release, and we are progressing that. And I'm really excited to announce that very soon. And what's in the mix now is biometric logins. We're turning the app into more of a utility where you don't even have to log in to gain some utility on the app. So it will give you live pricing on KAU and KAG, from looking at it just without even logging in. And, so it's just a handy function to have in your pocket. And then when you want to log in, rather than putting your password and your email in every time, it'll be a simple fingerprint and the ability to set up a PIN code as well, just like a banking app. So, to bosh out 6 digits on a PIN, rather than having to type in all of that login information, is going to be something that's just going to make it easy. But we've also done a lot of UI and UX development work on the app to bring you better, more structured information architecture, to bring you better coloring and better styling and better user experience across the board in many, many areas. There's too many to list and go through on this quick summary in this short break. But what we'll be doing is releasing a full release notes on the app release as it gets updated. And that'll be with you very, very shortly. So hopefully, within the next 3 weeks to 4 weeks, you'll start to see these new iterations of the app come out. And, we'll put full release notes there as well. What we're actually working on currently at the moment is redefining and polishing and restructuring, or redeveloping and restructuring our desktop application. So there's some really, really exciting stuff coming up within the next 2, 3, and 4 weeks. So I'll start with what's coming up in the next 2 weeks, is the integration of Bitcoin pairing. So we are the way through that now. We're into the testing mode of that. And within 2 weeks, we'll have Bitcoin, up on the exchange. And then closely followed behind that will be USD Tether, which will be a great way for people out there in the crypto community or digital community that want to actually manage their digital portfolio in and with Kinesis. And obviously the benefits through managing your portfolio with Kinesis is that, if you've got volatility out in the market on your Bitcoin or your Tether or your Bitcoin or your Ether, rather than being just stuck to Tether, you've actually got a new stablecoin, a leading stablecoin, a simple stablecoin backed one-to-one with physical gold or silver that you can start to go in and out of your digital currencies with. So it's expanding the range and the offering within the exchange, and giving you the ability to easily transfer into gold, at the click of a button. So this is a great addition that we've got coming out. And I guess, moving on from that into the 4-week period, after we get these new pairs on, yes, we will be putting more pairs on after that, but in the immediate time, what we've been working on is a new exchange user interface. This will be in line with best practices for a professional trading exchange user interface that you'll be able to use on the desktop. This is going to have, your markets, proper charting, drawing tools, indicators, the proper time frames, really good information, really well designed, really well placed. And it's just going to give you the ability to, get in and out of trades and look at where your orders are at and place orders in a very, very simple way. It's new and improved. And that's sort of leading into where we're going next. And that is starting to bring some of that awesome functionality that, we at Kinesis have been, saying from the beginning that we want to make gold and silver easy and simple to use for everyone. And we're talking about introducing order systems where you don't need to go onto the exchange. If you want to, purchase KAU or KAG or convert, your Ethereum or your Bitcoin, you can do it with a simple click of a button rather than actually having to use an exchange interface at all. So therefore, we're sort of going into a phase where, you'll have the ability to operate and spend and use and load up your gold and buy gold and silver and convert your crypto, and you wouldn't even know how to use a trading interface or have to know how to use a trading interface. This is in line with us becoming more adopted, easier to use, and simpler for people to understand. So, that's all in the works, and I'm seeing some of the dashboard designs at the moment and the user experience stuff, and it's looking amazing. I'm excited to bring this to you guys, and on that note, we will be bringing this to you. So we will be setting up some surveys with our new UI UX team that will bring user testing into this to our audience. So it's going to be an opportunity for you to get a little bit of a sneak peek into some of the functions and some of the things that we've done on our new sort of KMS dashboard layout, which will ultimately make its way to mobile as well. It'll give you an ability to come on as a user tester, somebody that can help us really define what it is that you want and what it is that you find good about what we're doing and or not, and to gain some insight from you. So that's going to be an exciting sort of step forward as well, where we're going to be more inclusive with our community right at the prototyping stage. So stay tuned and watch the space for this, because that is coming. So I'm excited to announce that very, very soon. I also wanted to just cover off a couple of little pieces here that have come to my attention over the last few days. I guess the first of all, is the debit card. The debit card is progressing really, really well. There are many aspects and regulatory hoops and legal things that we have tackled along the way, all of which we have passed, and we are coming through into a period of consolidation and all of that, to the point now where we're finalizing the last pieces of our development on the compliance sides for the debit card. So, over the next sort of short while, we're looking to still maintain and hit our Q2 goals for the release of a debit card. And we're working hard towards that, and it's all looking really, really good. We have a lot going on in the debit card world that is not just about opening up a region, but many regions. So along with our roadmap, as you're aware, we've just opened up Latin America, and we have things going on in Africa, as you're aware, with our head of Africa out there. We have lots going on regionally with debit card programs as well. So we've become somewhat experts in the space now of knowing how to put these debit card programs together, and what are the characteristics, traits, and deal structures that we look for in doing this. So we've become quite good at it, and it is all rolling, and it won't be too long till everybody will have a Kinesis debit card in their hands and is able to transact using their gold and still the portfolios, or if they want to, they can start to convert their fiat, their cryptocurrency, and use their fiat as well. So it'll be an all-inclusive sort of system that you wouldn't really have to use your traditional bank to transact anymore. You can start to bring your money across and transact in an open and honest system like Kinesis. So it's really, really good inroads being made there. I'm not going to give any firm days at the moment, because things can have a habit of coming down, but we are still on track for our Q2 goals, and we are working very hard towards that. And I guess just last of all, I'm seeing a lot of things out there with marketing. Where's our marketing, and why weren't we listed in this article or that article? We have an extensive PR and marketing campaign coming up. People that are paying for articles out there and getting paid exposure can say what they want in the market about them being the best gold back this and that. But ultimately, if you hand somebody a few $100s, stuff like that can be published. And at the moment, what we're really trying to do is execute on the vision of Kinesis to get it to a point where we are that. Not only are we able to put digital gold and silver in the hands of every person on planet Earth, but we're also able to do it in a way that we are satisfying the vision of usability and the simplicity of being able to use that. We want everybody to be able to hold Kinesis in their hand and want to tell their friends and family, because it's just so good, because it works it's so easy, it's so simple to understand, it's so simple to use. We are getting there, and until the time that we get there in a way that it makes sense for us to launch our marketing campaigns in a big way, we are continuing on with our institutional deals and commercial stuff to get all of the foundations laid in that regard. And then what we'll do is we'll switch marketing on. By the time we switch marketing on, we're putting an extensive strategy in place. It's been in development for quite some time. We have a lot of resources that we are pulling together that come from the team and our professional networks and our infrastructure and the years and decades of experience of the team members that work at Kinesis, all coming together to sort of hit that button and for everything to explode. But timing is everything in that case, and we want to do it organically. It's not just about paying for articles, it's about getting genuine organic coverage and media exposure regionally and across the world where it makes sense. So do hold tight. We are I think, only just crossing over to the 6-month mark since we launched the product, or don't quote me on that, but thereabouts. It hasn't even hit our first year since we closed off the ITO. And by the time we do get to that year mark, I think that when we look back on it, you could say, wow, that was impressive. So I think, as the product comes together, I think there's a lot to be excited about. And I think it's all about pulling the trigger at the right moment. So please, do bear with us. But in the meantime, we've got plenty to keep you entertained by getting you included in the actual user testing of the product, and to be able to really get that right together as a community. So I think that's everything on my list here that I wanted to cover today. There are a lot more things in the mix here, but obviously as we go through into the next live from the vault, we'll cover more off, and obviously we'll have more special guests for you as time goes on. It's been a little bit difficult to get the guests in at the moment because everyone has various commitments with this lockdown and so on and so forth. So without further ado, I guess I'll just sort of hand back over to Shane now, and just say that we do wish you the best, and stay safe, and we hope everybody is okay, and hopefully soon we'll be able to come out of this crisis, and Kinesis will absolutely be poised and ready to go, and is not being affected here, and is ready to sort of rumble and get ready for 2020 as a big sort of launch date for us. So thank you very much, guys, and have a great day.
Thanks very much, Jai Bifulco, CMO of Kinesis Money. Thank you for that update. Timely update, of course, for everyone. And now let's go to Talking Gold with none other than Mr. Andy Maguire. Over to you, Andy.
Well, thanks, Shane, and thanks, Jai, for that great update. Look, I think it's been 3 weeks, actually, since our last webinar. So we need a bit of catching up here, but bottom line, I think the theme of the discussion today is about the paper market reset is very, very close. Now, I normally try and avoid to get too granular, too detailed from a technical side, but I think we have to take a middle line here. There are so many questions after the disruptions that we saw between the spot gold market in London, the local London market, and the futures market. So many questions and so many erroneous reports. Reuters the other day, for example, came out with the reasoning for this. There's a new contract I'm going to get into in a minute that the LBMA and the CME have colluded to put together to restore paper market liquidity. But basically, what they're trying to spin the story is that, the only reason that we've had some illiquidity issues is because 400-ounce bars need to be refined and sent to America. That does not happen. There is no flow of gold going into America. America does have metal ore, and they do refine some bars there. So most of the bars that are in the US are from the US. So a really erroneous report. So let's start by reviewing the footprints leading into, and this sort of to catch up from where we were 3 weeks ago. And then I'm going to walk us through, and I'm really trying not to get you bored, but honestly, it's so important to understand the mechanics of this and why this is going to set the price of gold in US dollar terms significantly higher. So let's start by reviewing the footprints leading into the desperation move by the LME and the LBMA and the CME to add paper market liquidity into a broken LBMA over-the-counter spot gold market. Now, to sum up the core issues we discussed in our last webinar, it was about the Fed's attempt to add trillions of dollars of liquidity, and that was not just about rescuing stocks. What we talked about was, in fact, really, and still is, about rescuing the $200 trillion US bond market from a total collapse. And this is the market that is the anchor for close to 300 trillion of derivatives that have zero intrinsic value. Now, bottom line, this is a liquidity crisis, the scale of which has never been witnessed before. And this is a direct bailout of hedge funds on the brink of collapse. Even more significant, a bailout of a daisy chain of too big to fail taxpayer-insured banks. Now, with the approaching derivative tsunami in focus, central planners moved to calm volatility in the foreign exchange markets. Now, this is a 5 trillion a day market, 6 trillion a day market, actually. Now, that's easy to do in fiat currency crosses. I mean, like dollar yen, euro dollar, etc., because they're anchored to nothing. I mean, it's paper to paper. It can be generated from thin air. Now, all you have to do is open up the spigot, the QE spigot in this case, and flood the global markets with freshly printed dollars. However, the elephant left in the room after all of this was the inability to provide liquidity to the second largest global foreign exchange cross behind the euro dollar, foreign exchange gold. That is the Loco London foreign exchange gold cross. Now, we've discussed this in prior webinars, and please review why we know this is a foreign exchange cross, not just a commodity. So really the reason why, because ultimately you can't literally, ultimately it has to be physically delivered. And that was not possible by just adding liquidity. Now, as far as gold and silver was concerned, this hunt for liquidity is what triggered selling in the only other market sufficient to raise instant cash. And this is when we went through the thick of this last time. GC, which is the proxy for gold in the futures market proxy for gold, was sold, borrowed, and officially short sold in an attempt to provide liquidity. And this is why we witnessed such a deeply oversold gold and silver market condition develop. However, all the knee-jerk short selling in paper, gold and silver, will have to be bought back. And it's clear that there is no physical to back these naked short positions up. It was a desperation move. Bottom line, in their attempt to tap into the only other source of liquidity, the plunge protection team, which is on record as existing, had borrowed hundreds of tons of undeliverable gold, and in doing so, had pushed the short cover envelope to the absolute limit. Then 2 weeks ago, the paper market finally broke. And that's really what we're going to kind of concentrate on. Now, we'll look at this in more detail and explain why we've been evidencing major dislocations between the paper and physical markets. And this is and what this is actually going to lead to. In fact, all of the questions I've received revolve around this very subject. So with that kind of stage set, let's fast forward to where we are now from 3 weeks ago. And it's been another wild 3 weeks since our last webinar update for all asset classes and crosses. And when I say the crosses, the foreign exchange crosses, bond crosses, etc. Now, with regard to gold and silver, it's worth stepping back to assess the main points gleaned from our most recent interactions with our banks, our liquidity providers, family offices, and large funds that we trade and advise for. These are multi-billion-dollar funds. Now, this is especially relevant as on Monday, and we're recording this on Tuesday, yesterday, the new CME 4GC gold contract was launched. Now, this is a contract that is being deployed by central planners as a desperation measure to restore an element of paper market liquidity following the reported massive failures to deliver on large tonnage size spot index purchase, i.e., people had bought the over-the-counter market, locked into a price on ounces, and then gone for delivery. Well, when they went in to get delivery, there was nothing there. And they did this as gold was short sold into the 1460 dips on March the 16th. So deeply oversold. Basically, because of the reasons I just given, it was a desperation move by officials to try and find some liquidity and to short sell and borrow futures to actually raise that cash. Now, being called upon for delivery actually forced a $80 to $100 bifurcation between spot gold and futures as the exchange for physical premiums blew up, trapping all the usual suspects, including the Bank of International Settlements. Now, please go back to prior webinars and have a look at, we explained what exchange for physicals are, and really it's an emergency measure for converting a futures position into a spot position, but really not the best way to do it. So basically, what happened was the key liquidity providers had no physical to back up the positions they were being asked for, and they literally bailed on these delivery requests and obligations, to be honest. Now, the breakdown in the single largest global foreign exchange market behind the US dollar euro cross has turned into a massive embarrassment for the LBMA, who failed in their mandate and obligation to make a market in the over-the-counter for FX gold. It is their duty to do so. Now, the LBMA conduit will never be trusted again. It will force participants who were held hostage while the EFPs blew up in their faces, and they had to secure, in other words, they were trying to secure physical, people who were trying to secure physical in the future. So basically, it failed. Now, what also could not be hidden was that these EFPs, exchange for physicals, this conduit between the CME and the local London over-the-counter market, when it broke down, it evidenced plus $40 premiums versus the usual $2 premium to settle these contracts. Now, when you think that we're talking contracts that are in the hundreds of thousands, then you're basically looking at massive losses in the billions, in the multi-billions, enough to actually, I mean, this ballooning $40 EFP premium was unprecedented, never been seen before. It reflected a slew of massive offsite, undeliverable paper, physical delivery requests, potentially expanding, as I say, these losses could have expanded into the trillions of dollars. No one had any physical to deliver. And it was these underwater short bets that forced liquidity providers to step aside, and literally that broke the over-the-counter market. That's what happened. And as we've reported multiple times over the years, a spot index position, just so you understand it, that is tendered for a T+2 delivery, i.e. you put the delivery in, you expect delivery within 2 days, it pops out of a smoke and mirrors world of around 1,000 tons of paper gold cleared between the books of the daisy chain LBMA bullion banks every single day. But spot index delivery requests cannot be identified until the requests for the delivery are made. So out of the 1,000 tons of paper gold cleared every day, really 3, maybe 5 tons on a good day of gold are actually physically delivered in London every day. So when a paper gold position is demanded for delivery, it's not on the radar until the request is made, hence the problem. Now, bottom line, what broke on Tuesday, the 24th of March, was the tendering of hundreds of tons of spot index positions that we had reported that were going to demand T+2 delivery on Monday and Tuesday, the 23rd and the 24th of March. Well, with the over-the-counter related LBMA spot markets broken due to a slew of unfulfillable delivery demands in an emergency attempt to restore paper market liquidity, the LBMA moved to collude with the CME to provide, and I will stress, unallocated loco London paper gold settlement for delivery obligations. Now, this provides a band-aid replacement for the broken non-delivery EFP safety valve to buy time to cover off massive underwater, naked short offside bets. But this is not fooling anyone. There are so many layers to this scramble to restore paper market liquidity, and we could spend a full hour drilling down, but cutting to the quick. To sum up what this means as we go forward, we need to explain just a little more detail. Bottom line, the massive contango dislocation between spot gold and futures, i.e. futures trading so far above spot gold, cash gold, was caused by the LBMA's market-making liquidity providers who are called upon to deliver this physical, forced to exit these positions at any cost into a liquid, disappearing, widening bid-ask spreads. Now, if you're a trader and your bid-ask spread is not close, you're going to just have to hit whatever you're offered, which on Tuesday, March the 24th, when the EFP's contracts blew up in their faces, it expanded the two-way spread in London market to $100, i.e. the difference to buy and sell a single ounce of gold was $100 different. So what? So this is what is so little understood. This lack of market depth forced unallocated, over-the-counter spot gold longs to sell, this is the important part, to sell their over-the-counter longs at market, and we just told you how liquid that was, in order to cover directly related, deeply offside rising short squeeze futures contracts, i.e. that is how the EFP works. You're long one side, short the other. Now you've got no market in one, and you're forced to take whatever that is at a massive $100 discount and buy back a futures contract. We're talking about the worst case situation that could possibly happen to a massive trading bank. So this unprecedented failure to deliver, because there's no other way to say it, this scenario was not foreseen. And with no physical to deliver, nor the ability to offset this exposure, it required an immediate, officially sanctioned bailout to avert what would have been an immediate cash gold reset. And such an overnight gold revaluation would have exposed the entire daisy chain of taxpayer-insured, too big to fail banks who are exposed to trillions of derivatives exposure to do nothing but fail. So this is exactly the warning we went on record with when we had a Member of Parliament, Jeremy Lafloy, ask questions in Parliament on the 8th of July 2019, which is on record, which led to our meetings with the now Bank of England Governor, Andrew Bailey. Now, I went public on our subsequent formal meeting with Andrew Bailey, who was at the time head of the FCA. And at that meeting, we ran through how exactly these EFPs ultimately exposed the too big to fail banks, taxpayer-insured banks, to massive losses. The single one focus we left Andrew with and the FCA to investigate was the abuse of the EFP conduit before it blew up. This involved communicating with the Department of Justice, the CFTC, and the LBMA. Clearly, the warning went unheeded. However, it is on record, and there will ultimately be accountability as the FCA and the Bank of England sit on the monthly LBMA meetings. Now, I would love to be a fly on the wall after the LBMA failed in their obligation to make a market in gold, the second largest foreign exchange market globally. Now, importantly, even if the regulators fail in their duty after being hung out to dry on long-standing bets, trust in the LBMA is now irreversibly shaken. Now, clearly, in the 7 months we've formally drew the regulators' attention to the loophole, exposing these UK banks to potentially trillions of naked short derivative exposure, nothing was done. So now the fallout begins, and the only solution is to allow gold priced in dollars to rise. So that's the bottom line of it. So as we know, this is where so many questions have been asked about this new contract, this cobbled together 4GC solution that was launched a couple of days ago. It's little more than a band-aid stuck on a bleeding artery. The CME will now allow, I say, delivery and settlement of local London unallocated 400-ounce LBMA bars. Now, this contract now trades alongside the long-standing GC, which is the futures contract, 100-ounce contract, which has been trading since 1972, I think, 74, but will be directly exchangeable by way of accumulated certificates of exchange, i.e. an ACE. It's called an ACE. Utilizing these clearinghouse certificates, these ACE certificates, CME will be able to enable inter-commodity spreads between the two contracts, enable participants to move positions between contracts. In other words, what does it mean? Settle in paper gold. But this new contract will do little more than replace the broken EFP conduit. Drilling down, this became apparent. Now, the EFP process already allowed COMEX GC futures positions to be exchanged for local London 400-ounce bars. So this fresh emergency strategy to add paper market liquidity, evidencing two competitors, the LBMA and the CME, to collude to create a conduit into the undeliverable unallocated local London paper contract, is just a ruse to add desperately needed paper market liquidity. And this follows delivery demands overrunning the ability of their over-the-counter liquidity providers, which is the major bullion banks to deliver physical into a massive overhang of unanticipated delivery demands. Now, this desperation measure will actually serve to close the contango, this spread between spot and futures gold. However, the LBMA's Achilles heel is still exposed, as the directly related spot index positions we talked about can and will be demanded for physical delivery in London. Ultimately, this is bullish for US dollar price gold, regardless of the recent scramble to hold gold down. Now, to back this assessment up, following a series of calls with key liquidity providers, banks, family offices, and large gold trading funds this week, one common thread came through, namely that pent-up physical demand is unprecedented. And on Friday, what very few physical bars that were offered by a Swiss bank to wholesalers was strictly rationed and commanded an unprecedented $500 per kilo. And I'm talking about wholesale to wholesale. Now, with this Friday offer quickly oversubscribed, i.e. you want more, you can't have it, we can expect any further offers to sell to raise the offer to sell. So not to forget that all European refineries were already sold out before the shutdowns and with massive orders in the hopper backlogged. And now that the refineries are beginning to restart, these orders will be many weeks behind. So as a result, first in line orders that were already booked and paid for will continue to command substantial premiums because they're at the front of the queue. Now we see the offer to sell any immediately deliverable on-hand bullion as rising significantly, which in turn will lead to another futures market short squeeze in anticipation of the physical market reopening at full capacity. So really, as far as the EFPs are concerned, this new 4GC Loco London delivery option will render EFPs as a less favored third choice delivery option, and spreads between spot and futures will be much tighter in order to prove to the BOE, the Bank of England, and that this emergency settlement is functioning. So they're kind of caught between a rock and a hard place. So really, bottom line, this changes very little. Although the paper-to-paper deliveries can be settled, the large T+2 over-the-counter spot index delivery demands that remain unfilled from March the 20th continue to accumulate. Now, all of this overhang will flow through for physical delivery and continue to force the over-the-counter long positions to be sold to escape delivery demands, which in turn will force the closing of the offsetting balancing futures shorts. This is a bullish setup, and insiders are doing everything to get long GC and SI, gold and silver futures, for their own books ahead of the forced short squeeze. So where does the wholesale global physical market value for gold and silver? Now this is the other major question. What is the wholesale global view of the price of gold and silver? Well, fresh gold and silver valuation metrics cannot be ignored. They put gold and silver well above the $1,900 gold and $50 silver 2011 highs. I mean, the cost, this is unprecedented. The cost to carry foreign exchange gold, which is the second largest global market after US dollar euro, is now 0 to minus 0.25%. This trade alone will attract billions of fresh interest in a long XAU short US dollar cross, long gold, short dollar cross, FX cross. Along with this net positive carry cost, which has never been the case ever in history before, trillions of fresh QE easily benchmarks gold well over $2,000 an ounce. And at an anticipated 36-to-1 ratio, that puts silver close to $55 per ounce. Now, you know what? This is not just my opinion. This is the opinion of liquidity providers close to the market. Deeply undervalued, oversold silver is coming onto the radar for hungry sideline money. We see silver leading the way higher for undervalued gold. And once SI takes off, silver takes off, there will be very few pullbacks and short covering opportunities. So really, I mean, while this, we talked briefly last time about the relationship between the algo that we'd seen develop between the GC and ES, and then we saw it appear in ES and SI. I'm not going to talk about that. We talked about that in a previous webinar. But bottom line, what are we saying here? The banking system is broken. COVID just accelerated this process. So I'm just going to finish up by saying there is a solution. However, what I'm saying is the Kinesis physically backed gold and silver monetary system, it is your solution. You hold the physical in our vaults. We have independently audited vault reports to prove it. They're on the website. Kinesis is the only, and Shane talks about this, it's the only gold and silver-backed monetary system that defeats Gresham's law. This directly benefits you. And when you spend or hold your gold and silver with us, it rewards you. So what I'm going to ask you to do is come onto the world-class Kinesis.money website and find out why. Come and join us and become part of the solution, guys.
Well, there you have it. I want to thank you so much, Andy, for that awesome update, a detailed update. You got right into the granular topic here of what's happening with gold and silver. It is a lot of information, but one thing I know for sure, gold and silver, I'm talking physical gold and silver, will never go to zero. All right. This is what I'm fired up about. The timing is everything. You know, I heard something just this week. I'm not really sure who wrote it. I'm not really sure where I read it, but it made so much sense. It's hard to teach someone who's drowning how to swim, right? So again, I'm going to end and conclude with this. If you have not already looked into Kinesis and Kinesis Money, you can go to my.kinesis.money, and there's a 10-minute video that kind of walks you through the steps, and you can register to also learn. There's 11 videos that are 2 to 3 minutes each that will step you through the entire Kinesis system. It's awesome. It's free. All you got to do is go sign up. So go over to my.kinesis.money and register for much more information and all the FAQs. So with that, we will see you next time on Live from the Vault. Bye for now.